Everyone, thank you for joining Troy and I today for our Angel Investing 101. This is meant to be a primer for people that, as I like to call, are angel curious, or maybe you've done a little bit of angel and you're now trying to get a little bit more formalized in how you think about it. We will touch on potentially some more intermediate topics, but we're going to try to keep this relatively basic and give you a good framework to go from. Troy can introduce himself and I'll go after. Go ahead, Troy.
Great. All right. Thanks, Chris. So real quickly, I think it's important for you to have an idea of our background and why we think we have something to add to this conversation. So I know many of the people out there, I'm a serial entrepreneur. I've built a bunch of companies, but most importantly, I've invested in over 200 of them. 32 of those as an angel investor, but another 170 between Techstars and as a venture investor. And so I've seen this game played out many, many times. And I'm excited to share with you some of the tips for getting started with angel investing.
Yes, and Troy is not just awesome angel investor, but he's also a fantastic teacher. He's been a mentor to me for a long time, really since I got here to Chicago. And even though I did my first angel investment 25 years ago, over half my life ago, really over the past decade is when I've been materially moving more into angel, and Troy has just taught me. So a lot of what anecdotes and things that I'll be sharing are things that I've learned throughout the years from Troy. I've been doing the 85 investments are really just since I came back to Chicago. I did a couple before that, but materially it's been over the past decade since I've been in Chicago. And Lofty Ventures is the platform that I've built to support the 154 founders that we have at the 85 companies inside of the Lofty family. 75% of those companies are led by underrepresented founders, and 85% of those are here in Chicago. Lofty Angels is the next community that I've built inside of the Lofty Ventures community. And that is really meant to be an open sourced free community for people to learn angel investing, whether they're at the very early stages, I like to say angel curious, or all the way up to what you may consider to be an expert. And Troy and I joke, there is no real expert. You're always learning. So maybe at the higher end of the spectrum. And it's just a great opportunity for people to collaborate, learn together, do events exactly like this. And then I'm also another sort of side job that I do is I'm refounder of T-Bot. I invested in them in 2015 when I found them at Y Combinator. And if you know me, you know I'm a big T-Bot and big T fan. So that's another hat that I wear.
Awesome. All right. So I want to start out by defining angel investing because I want to make sure we're all on the same page here. And I define angel investing as an individual who is investing his or her own capital. So if you think about it, you've heard of an angel fund. I think that is a misnomer. There can be no such thing as an angel fund in my world because it's someone making the decision for their own money. And the reason this is so important is that the way an individual makes a decision about making an investment is very different than some of the other categories. So for example, it's more sophisticated, hopefully, than friends and family money. And I define friends and family money as people who are not making a habit of regularly investing in companies, but have invested in an entrepreneur because of a relationship. And they just think, you know what, I want to support this person. I'll make an investment in it. It's somebody I've known for a long, long time. It's really about the relationship. It's not about the business. And it's also very different from venture capital, which is where I spend a lot of my time. And the reason for that is in a venture capital firm like Math Venture Partners, we have money from many limited partners or LPs, and we are investing on behalf of them. And since we're investing on behalf of them, we have to do things like serious diligence. We have to have a thesis that we're investing behind. We have to have a defensible position in every investment we make because we're investing other people's money. Going back to the left side of the screen, when I invest my own money personally, I can invest for any reason I want. You know, I could meet someone on a Zoom call and say, I really like the color of that shirt you're wearing. I'm going to invest. It's my money. I can do whatever I want. That's important to know, especially as the entrepreneur, to understand the motivation. Now, I don't think it's a good idea for you to just invest for any crazy reason. And so I want to talk about this. You know, hopefully all of you on the call are thinking about doing some angel investing, and we want to give you some frameworks and some ways to think about this to hopefully be more successful. The first thing is you've got to have a plan. Please, please have a plan. And we're going to talk about what that plan may look like. The second thing is that you have to have a lot of patience. Angel investing is something that takes time. You're playing the long game. I've invested in 32 companies, most of which are before we started Math Venture Partners. So going back from 2008 to 2014, and most of those are still operating today, right? It takes 10, 12 years to get exits from these companies. But if you have a plan and you have patience, it'll make you a great angel investor. But I want you all to remember the #1 rule of angel investing, which is do no harm. Right? I have seen situations where angel investors have come in thinking they're helping companies, thinking they know better, and have actually messed things up inadvertently, whether it's by messing up the cap table, whether it's by being too strong-handed. We can talk about some of that. But rule #1, Chris and I talked a lot about this, is do no harm. We're here to help early stage startups. If there's a company you don't want to help, that's fine. Don't help them, walk away. But don't get involved and do harm. Do no harm. All right. Awesome. A couple of facts. I just went out and did a little research. There are over 250,000 active angel investors in the US. That means you're not alone, and there are a lot of people you can learn from. We're not doing this by ourselves. We don't all have to make the same mistakes over and over again. The average angel, according to the American Angel Report from last year, has made 19 investments. This is all about portfolio size, and you're going to hear us talking more and more about portfolio size. And the reason portfolio size is so important is because from that same survey, the angel investors reported that only 11% of their investments had a positive return. So if you only make 1, 2, 3 investments and you're not lucky that that's one of the 11% that has a positive return, you may get no return, right? By building a bigger portfolio, you have a higher chance of getting those returns, and those returns can be quite large. Over $24 billion in angel is invested annually, according to them, and helps move 64,000 startups. Like this, I like the line, little checks, big impact. We are having a big impact on the community by doing this. And the investors who had 12 or more angel investments and had held them over 5 years had a 75% chance of getting more than a 2.5x return. 2.5x return, we're starting to get into the area where that becomes interesting, right? Another fact, 22% of angel investors are women, which is way bigger than the percentage of venture capital funds that go to women, which is under 2%, which is crazy. It's our hope that by getting more women involved in angel investing, we will fund more women founders and get more diversity. And I know that this is a big point of Chris's strategy, and it's a piece of my personal strategy as well. And then interestingly, most angel investors are outside the big areas. And actually, the Midwest is cited as one of the most active angel investing areas. So just to lay a little bit of groundwork. All right, so we talked about having a plan. And the first thing is you must have a why. And if your why for angel investing is, I want to make a lot of money, I suggest you go do something else. That's not the right why. You can make a lot of money doing angel investing if everything else aligns right, but that should not be your primary why.
It should be a why, though.
It absolutely is part of the equation, but it's not the primary driver. And your why can change over time. And I will tell you that when I first started making angel investments, I was trying to select companies that I thought were going to have the biggest outcome. And it was about supporting the community was my why, my primary why, and making money. As I've evolved over time, I actually have some things that I want to try to accomplish with my dollars that are more than just about making money and supporting the community, but supporting specific sectors of the community and the underrepresented founders out there, and trying to give them access to the network that they may not have, and building relationships with founders. I have some really deep relationships. My first angel investment was in a company called Next Big Sound back in 2009. And I still talk to those founders all the time. They exited, they sold to Pandora a long time ago. All right, so have a why. The second thing is adhere to your plan. When you make the plan, it's not good enough to just make the plan. You actually have to live by it, right? And when we talk about mistakes, one of the mistakes I've seen many people make is they have a plan and then they don't follow it, and they end up with this hodgepodge portfolio that doesn't deliver on any of the promises. Speaking of portfolio, you need to build a portfolio. If I knew which ones were going to be the winners, I'd only invest in them. I have many people over the years who've come to me and said, hey, I'm thinking about making an angel investment. What should I do? And the first thing I do is say, you shouldn't make an angel investment unless you're willing to make at least 10, right? You need to build a portfolio because nobody is smart enough to know which ones are actually going to be the winners. And so we need to build that portfolio. Remember the fact, only 11% of the companies that the angels had invested in had a positive return. You want to make sure that you have some of that 11% in your portfolio.
Right. I'm going to give a quick example of this that I hear all the time. Either it's happened already, or the early investor, new investor, is discussing doing this. They have a friend that's raising money, and they came to them as like a friends and family kind of situation. And they're really excited about they being the potential investor. And they say, I'm going to write a $25,000 check into this. I go, great. So is this your first check? And they go, yeah. So you're planning on deploying about $300,000 over the next 3 years, right? And they go, what? And I said, well, you want to make sure that you've diversified your risk across many companies. And that's basically a dozen companies over the next 3 years. So multiply that 25,000 times 12, that's 300,000. And so if you get into one of those situations, you've been in one of those situations, it's a little bit challenging because you maybe are really excited, but you don't know anything yet. And it's really, really important that you're thinking in this longer term, bigger plan. And you're not just saying, I'm putting all my eggs in one basket, meaning if I want to put $25,000 over the next 3 years total, you need to divide those by 12. And that ends up being about $2,000 per investment. So it's really important that we think about this well ahead of getting that person that comes to you and says, make a $25,000 investment in my company.
Yep. And Chris, not only do I want to say I couldn't agree with you more, but the next bullet point on my slide is consider how much you want to allocate over the next 3 to 4 years and how many investments you want to make. Minimum of 10. I like Chris's 12 even better. An example I'll use later is 15. And you do the math. When I started angel investing, I had $100,000 I felt I could deploy over 3 years, and I wanted to do 10 investments. So I made $10,000 investments. That was what I could afford to do at the time, and that's what I did. And I made 10. After I made those 10, I then reevaluated. I had some exits. Sure, payroll had sold at that point. I was able to do a little more, and I took another chunk of money and I divided by 10, and I started doing investments at that rate. And so you really do have to have a plan. Chris is 100% correct. And now, the one piece I will say, if it's friends and family, if this person who came to you, Chris, and said, oh, I'm investing 25,000 because, I've known Matt since he was a little kid, I've seen him be successful and I want to invest in him. If that may be the only investment the person wants to make and they're doing it to support a friend, that's fine. But it's not a strategy for getting returns as an investor.
And be very clear, not just with if you do that one off, because it is truly a friends and family situation and you don't really want to be an angel, you just want to support this friend, you have to realize that it's incredibly likely that that's going to go to zero. It's incredibly unlikely that that turns into a huge win. And there's lots and lots of reasons for that. So you need to be very okay with, if you're at a $25,000 check for that one off, you are probably not going to get a penny of that back. But you also need to be going into all of your angel investments with that approach as well. You don't want to take all of your savings and put them into angel investing, because even though the statistics say 11% of the companies you invest in will be successful, it could be zero. You could be the outliers where it actually every single deal that you did goes to zero. So you have to be thinking about the capital that you're deploying here is a very small piece of your overall savings and your overall portfolio of investments that you've made throughout your investing career.
Yep. And especially with friends and family, make sure that the people are investing money they can afford to lose. You don't want to be sitting across the table from Aunt Ruth at Thanksgiving and you just lost her in retirement savings. So, all right, let's keep rolling. Figure out the reasons to say no. Here's the deal people don't realize is that investing is really about saying no. So at math, we would look at 2,000 companies a year and we'd invest in 3 or 4, right? So that means we're having 500, 700 no's for every yes. Make it easy for you to say no, right? These are some examples as an angel investor. I have a particular geography I'm interested, a particular stage of business. I require you to have a technical co-founder. I only invest in certain sizes of rounds. I'm B2B, I'm B2C. I want some diversity in founder demographics. I want a minimum potential of return. If everything goes well, I want to be able to get at least a 10x. These are all reasons you can say no. So when you look at a company and they don't have the things you want, it makes it very easy for you to say no and filter so that you can focus on the smaller subset of companies that are in your wheelhouse that have potential. So if they're outside of Chicago in this particular case, no. If they don't have a technical co-founder, no. If it's not B2B SaaS, if there's not founder diversity, the round is too big, potential, they have too much revenue, no, 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 no. That makes it easier for you to focus on the things that you really want to do. So figure out how to say no more easily.
Quick note on this. My filter is I focus on Chicago companies. That's a very easy, quick filter. The more that you can also make public, if you're an angel investor, some angels actually want to stay pretty off the radar because they don't want to get bombarded or whatever it is. But once you start writing checks, people find out who you are and that you've written checks. So you're going to get inbound. The more that you can publicly say, whether it's on your LinkedIn, maybe you have like I have loftyventures.com as my website. And I try to be pretty clear, if you're not in Chicago, then I'm not really looking to make those investments. There are outliers, there are exceptions. So if you do approach an investor, if there are people that are looking for capital on here, which I'm sure there'll be some that watch this, make sure that you're telling the investor, this is why you should still look at me, even though I'm outside of your thesis. And for us as investors, the more that you can make those, what are the things you look for public, the more it's going to help founders filter out. So you're not getting a lot of stuff that's just not a fit in the first place.
Right. It's good for you. It's good for the founders. You don't want founders wasting their time chasing down people who are not going to be investors. So let's turn this into a practical example. I made this up. This is fictitious. But let's say my why was I want to share my experience building B2B SaaS companies with entrepreneurs. I want to roll up my sleeves and help them in a meaningful way and help them get outsized returns. Okay, that's fair. Maybe that's right. Then I have to quantify that. Well, I'm only going to invest in B2B SaaS companies. I want to do early stage. I've decided pre-revenue only up to 10K in MRR. I want to write $20,000 checks average. And by the way, as an angel investor, I strongly suggest you make all your checks the same or very similar, because again, you don't know which one's going to be your winners, and you want to make sure they all have equal weight, so that if your winner happens to be one you didn't expect, you wouldn't want it to be one that was lower weighted. So you try to make them the same if you can. In this case, I said targeting 15 checks. Wow, that's $300,000. Oh, I've also got to do some follow-ons. Maybe a third of them will have follow-ons. That's another 100,000. So that's 400,000 over 4 years, 100,000 a year. Now, that's a reasonable for someone as an angel investor. You may be thinking, wait a minute, I don't have anywhere near that kind of capital. I like, I can't do 400,000 over 4 years. I might do 40,000 over 4 years. I might do 10,000 a year. And then you can still do that. You're going to be investing typically through things like syndicates, which is something that, Chris is putting a lot of work into, to making it easy for people to dip their toe in the water with much smaller investments, 1, 2, single digit thousands, $5,000 per investment. This is just an example to make the math easy.
And you can even go lower dollar amounts too on crowdfunding
sites. Yep.
Like Republic, and you can even do that as an unaccredited investor. And we'll probably get to a little bit of what the difference is between accredited and unaccredited. But don't get intimidated when you see $300,000 or even $25,000. You can actually start as low as $100 per investment on places like Republic.
Yep. In this case, this fictitious person only wants Chicago-centric founders because they want to facilitate in-person meetings. And I think it's important. I learned this lesson fairly early on, which is should you follow on and shouldn't you, and putting some guardrails on it. So I made this up. Follow on has to be under an 18 million post. And the reason for that is that you have a choice with your dollars. You can put it in an existing deal that's going well, which sounds great, right? You want to lean into those deals that are making a lot of money. But at $18 million post-money valuation, your dollar is buying a much smaller percentage of the company than if I took that money and put it into another early stage pre-revenue company where I might be able to get 5 times as much of the business, right? I might be doing something at a 3 million, 4 million post. And so you should have some guidelines about when you do follow on and when you don't. It's a little bit in the next session, not the 101 session, but the 102 session. So we've talked a little bit about reasons to say no. Now let's talk about reasons to say yes. The first thing is, and I cannot underscore this enough, it is all about the people. People, people, people. So the example I like to use is if you have 2 companies and one is super early stage, let's say it's pre-revenue, and one is a publicly traded company like IBM. It would be reasonable for me to make an investment in IBM in the public stock market, having never met the CEO. It'd actually be reasonable for me to make an investment in IBM just by looking at some numbers and some spreadsheets and not even knowing the name of the CEO. I don't know who the CEO of IBM is. I know it was a woman. I think she left. I don't even know who it is, right? But I could look at the numbers and make an investment in IBM. Because it's all about the business and the metrics and the ratios. In an early stage company, especially pre-revenue, the likelihood is that whatever they're doing now is going to pivot, and it's going to pivot multiple times. And so you can't make a decision based on the business model they have today alone. You're actually betting on the humans. And if you have really great founders, really great entrepreneurs who are going to understand the market, who are going to make good decisions, the business plan can change, but the humans who are running it won't. And so I really like to say that the earlier stage, the more the humans matter. And so you have to spend time with the founders and you have to understand. This is why I think it's so ridiculous that people will make angel investment decisions off of a deck. You can't learn anything about the people off of a deck. The deck should just be a teaser to get the meeting to really get to know the people. You're betting on the humans. Chris, I'm going to let you explain this because this is yours. I stole it from you.
Sure. I actually changed the order on this. I call it problem founder fit, but this is one of the criteria that I personally use, and you need to create your own criteria that you look for in founders that you're backing if you're going at these very early stages. Problem founder fit is how I describe a founder having personal experience with the problem and really hating it. It's really important that the founder hates the problem deeply, because that's what's going to get them through the troughs. You have valleys and you have peaks and valleys or troughs in building a startup. And when everything's up and to the right, it's great. But as soon as you have the first sign of trouble, if the founder doesn't really hate the problem, they're just going to pull the eject handle and move on. And that makes your capital at risk. So when I see that a founder has lived the problem, they're solving a problem that they used to deal with on a day-to-day basis in their prior life, that is a hedge for my investment. It's also the exact opposite of solution founder fit. Solution founder fit means, well, I know the solution, and of course this is going to be the right answer. The answer is you actually don't. You have a hypothesis. The market and your customers are going to tell you if it's the correct solution. So problem founder fit is a really, really important aspect to me for when I'm looking at founders.
And I love this because many investors talk about founder market fit. Does the founder know the market? And Chris has taken it 2 levels deeper. Not only do they know the market, they may have a hypothesis about the solution, but they're focused on solving the particular problem. I think this is spot on. It's awesome. Second thing is tenacity. This is hard. There is no 2 ways about it. I don't know a founder. Chris was there. We had Mike Evans in my class at Kellogg on Tuesday for final presentations, and he gave a little talk. For those of you who know Mike, he was the founder of Grubhub. He now is the founder of a company called Fixer. And he was talking about, God, I forgot how hard it was. He's doing it again, and it is hard. And this is a guy who built a company from his dining room table through IPO. Mike is really smart. He has great experience, and it's really hard for him. You need to be tenacious in order to get through this. Mike is tenacious and will get through it. I think when I angel invest, I'm looking for founders who are coachable. That doesn't mean that I have the right answer all the time and that I'm telling them what to do. That would be a marionette. I don't want a marionette. But what I do want is a founder who's going to sit down and talk through the problems they're having, listen to suggestions and ideas, and then make their own decision. We're betting on the founder, and we're not betting, I'm not betting on myself, but I think being coachable is super, super important. And then the last thing I'll say in this section is there are only two functions that matter in the early stages, building and selling. Everybody in the company has to either be building the product or selling it. All the other stuff is fluff. And so do you have a team that is maniacally focused on building a great product and selling it? At Math, we take it far enough that we actually say explicitly, to Chris's point earlier on our website, we are focused on teams that have an unfair advantage in customer acquisition because we think customer acquisition is what wins out in the end. I do too, so I focus a lot on the sell, but you still have to build. Build and sell, the only two things that matter.
Troy, I'm going to give one more example just so that people can think about, these are, you don't have to use this as your rubric. You don't have to use this as what you're searching for. It can literally be anything because it's your own money. And that's what's sort of fun about this. I'll give I have 4 criteria. The problem founder fit is my 4th of the 4 criteria. I'll give you my 1st, which I'm the only one that I know that actually even has this as part of their criteria. I look for givers in the Adam Grant give and take sense of givers. That is my number 1 criteria. And a big reason, life's too short. I don't have to do this. Angels don't have to angel invest. You choose to do it because there's some other reason other than just making money, as Troy said earlier on. And I do this because I love working with great people. And I want to surround myself with givers. And the 154 founders that I've supported in the Lofty family and that I've invested in are givers. And it makes my life better. I enjoy every day waking up and working with these founders because they're all givers. So that's an example of what might be considered an unorthodox criteria that you're looking in your founders, but be creative. This is a way to help shape the life that you're going to be living. And frankly, we're making investments with our dollars that's going to shape the future. So my argument is let's invest in good people that are trying to make the world better. And givers are always trying to do that. So this is all
right. So Chris, you made a sandwich. You told us that problem founder fit is the 4th criteria and givers are the 1st criteria. What's the meat of the sandwich? What are the other 2?
They're very quick. It's 2nd is brilliant, and 3rd is gritty, scrappy, be able to do a lot with a little, basically tenacity. So
yeah, awesome. Everybody will have their own rubric, but what's important is that you have a rubric and that you follow it and you're consistent. Can't say that enough. Let's talk a little bit about deal structure, and this may provoke some questions. I don't assume that everybody knows what all of this stuff means, but you want to think about, am I investing in a safe, in convertible debt, in equity? You usually don't have a choice. It's the deal that's presented to you. As an angel, you don't control the deal. You're not the lead usually, but you need to understand what the deal structure is and what the implications are. So one thing here in the state of Illinois is that 2 of the 3 of these, if done properly, you can get an angel investment tax credit if you do everything right. What that means is that if you invest $10,000 in a company, in equity, I'll say for the moment, in an Illinois company that qualifies for the angel investment tax credit and has filled out the paperwork, if you fill out the paperwork, you will get a quarter of that, $2,500 back on your state of Illinois tax return. Not a deduction, actual money back. So this isn't like a tax deduction where you reduce the amount of tax you owe by 5%, you reduce it by 25%, right? So, and the state of Illinois, though, for some reason, only considers an equity investment or a safe as eligible. They don't consider convertible debt as eligible because they consider it you're lending money to the company. So you need to understand some of the ramifications of this. But in Illinois, the Illinois angel investment tax credit's awesome. You need to understand valuation. There are some angel investors who don't care about valuation. They say, you know what, my strategy is to get into the great deals. I don't care what it costs to get in, but if I'm in the great deals, I'm going to win. That's not my strategy. I want to understand valuation because I am concerned about being able to get an appropriate return. I'm also concerned if the valuation is too high, what implications does that have on the company's ability to raise the next round, right? There's some subtlety in here, and I am happy to talk more about this in the Q&A section. I'm concerned, does the company have a real board of directors? Is there actual management going on here, or is it a couple people having a hobby? I don't have to be on that board of directors as an angel, and I rarely am as an angel. I commonly am as a venture investor, but it's something you should know about. And then on the diligence side, maybe on the diligence side, you have confirmatory diligence. Is what they told you true? They told you a bunch of stuff in the deck, and now you just want to confirm it. You know, take a look at the financial statements. If they talked about contracts with big companies that are make or break the business, you should probably take a look at that contract. Do they have proper employment agreements with assignments of intellectual property with their employees? These are things that, some of these things are things that a lawyer would take care of if you had a lawyer doing it. But if you're doing a small investment, you just want to be aware of these things. You know, does the cap table in Carta look like what they said it was, or were there surprises? And then again, we're investing in the people, and so you want to know about the people. And I strongly suggest that you source your own references. Just about anybody who's in the startup community, if you leverage tools like LinkedIn, you're going to be able to find somebody you know who knows that person. Not the ones they gave you, but the ones you find, so that you can back channel and learn from it.
Troy,
Hopefully they're awesome people, but if they're not, you'd rather know about it before you invest.
I'm going to give a quick, a very tactical example of how you can use LinkedIn to do quick references. When I am meeting with a founder, I pull up their LinkedIn and I see who are our common connections. And I will often ask them, if I have no background, if they cold reached out to me, I have no background on who they are. Usually, just because I'm connected to a lot of people, I have the ability to ask them, who of all of our overlapping connections, who are the top 3 or 4 that you know? And if one of those that they come back with is somebody that I know well, I will go and follow up with that person and say, tell me more about this individual. So instead of me having to go through all of their LinkedIn connections and all those people go, I don't really know that person. If I ask them while I'm live or on a follow-up email, it just makes it a little bit easier. This is one of the tools that I often use on a cold outreach.
Yep, absolutely. Again, coachability on the diligence side is one of the things that I'm looking for a lot. Closing time frame, you know, do you have the cash available? They want to close next week. Can you actually do that transaction? Is that realistic? So a couple of things on common mistakes. We're wrapping up and we're going to get to Q&A. So the first and most common mistake I see is people decide they're going to do this and they get too excited about their first deals. I was warned about this when we started Math Venture Partners, and I fell victim to it as well. Our first couple of deals, we probably looked at 10 companies and we wanted to invest in 4 of them. And if you think about it, I haven't even exaggerated enough to do this, but think about those bullet points. Would you rather invest in the best 10 out of 100 companies or the best 10 out of 1,000 companies? Of course, statistically, the top 10 out of 1,000 are going to statistically do much better than the top 10 out of 100, and certainly better than the top 10 out of 10, right? So be patient. Make sure you are playing the long game and you're looking at enough companies that you know what good actually looks like. When you start this game, almost every company sounds good. That's because all entrepreneurs are optimists. They have to be entrepreneurs. Another big mistake I see is people investing for the wrong reasons, right? If it doesn't meet your filter, just say no. Stay in your lane. We made this mistake in the first fund at Math Venture Partners. We invested in a couple companies because they were hot, right? This was a San Francisco deal and we got access to it. It's hot. We knew nothing about the industry. It didn't fit our stage. In the end, it was meh, you know, like that's the wrong reason to invest, right? And certainly investing in things you don't understand, you may as well just play the lottery, right? You can't add value. You can't be an angel and engage deeply. And so I try not to invest in things that I don't understand. In summary, wrapping up, make sure you have a why. Make sure you have a plan and stick to it. Build that balanced portfolio. Have a lot of patience. Absolutely have fun, work with awesome people, and make sure that you do no harm. Rule number 1. So that's what we had in the to chat about in the structured presentation. Would love to start taking some questions. And so I'm going to stop sharing and we will do that.
Sure, that was awesome. Again, I just want to convey to everybody how amazing Troy is at this. I've been learning for so many years. I've done actually one of my early instances getting to know Troy was he was giving a boot camp many years ago in 1871. And I think I got the do no harm from Troy in that boot camp, whatever it was 8 years ago. But it's a really important thing for us to and I'm just going to give a quick example. Here's one example of a situation where we can do harm as an angel, putting our founders on wild goose chases. They're telling you what their product is. And you go, but have you thought about doing this? And you could do this. That you could be feeding their minds with all this stuff and giving them shiny balls. And like, honestly, and unfortunately, that can actually do some harm. So you have to be very conscious and think about the sorts of advice and ideas that we share with our founders. We don't want to put them on wild goose chases. And also, and this is really important, this is probably the most important of do no harm. Do not give advice that you don't have real expertise in. This is something that happens all the time. People will give founders what they call advice, but they maybe heard it secondhand. They don't really know it. It's sort of something that they think, but they don't have personal experience in. So just a couple examples of do no harm. Troy, do you want to give one? Because I know you've got a million of these, and then we'll go into some questions.
Cap table stuff to me is a big one I've seen where angel investors can mess up a cap table, whether it's by trying to take too much in advisory shares. There are all kinds of things. I actually have there's a question in here from Anthony that I don't know that I fully understand, and I think it's related. Is it okay to have a percentage available in the company's common shares left for an angel investor if they invest in your company? So, Anthony, do you want to put a finer point on that? Because I don't know that I fully understand the question.
Yeah, let's come back to that, Anthony. You can throw it in the text chat. But we've got a bunch of great questions that I've been collecting because they've been DMing to me. So the first I'll go to, like your criteria for investing, personal, repeatable. I wonder what your process for getting the observations you need to answer those questions for yourself. Is it the questions you ask, reference questions, or meeting formats you employ? Troy, go ahead and I can give a quick response to that too.
Yeah, so for me, it's about getting to know the founders over time. And so I don't usually meet a founder and immediately, oh yeah, I'm going to invest. Like, it's not a one meeting thing. It's building a relationship over time and getting to know them. So I usually open with, how can I help you? Right? Someone referenced my open office hours, and I do them. I posted a link in the chat for it if anybody wants to use it or to share it. They're open to the public every Friday. And usually these things start with that. How can I help you? And we'll spend 30 minutes and we'll talk through some stuff. And then if they want to, they'll come back and on another Friday and we'll get to know each other over time. And then after time, we build that relationship and I start to understand that founder, and maybe they're raising a round and maybe we'll talk about it. But I lead with wanting to help them and wanting to build that relationship first. In terms of how do I discover some of this stuff as we start thinking about that kind of a relationship, is I tend to ask some very open-ended questions. I want to understand how the founder is thinking. So I will ask really open-ended questions like, what is your strategy for fundraising in the next round? Or what do you think is an acceptable rate of growth versus cash burn? And then I just shut up and let them talk. Because the more they talk, the more I'm going to learn about how they think about things. And by the way, these are not questions that have right and wrong answers. but they are questions that can reveal, are we aligned in how we're thinking? Because the most important thing is that for an entrepreneur is that they are aligned with their investors, frankly, and their employees and their customers. If you get all that alignment right, things move smoothly. When people want to go in different directions, that's when friction occurs. And so what I'm looking for is alignment.
That's mostly what I would answer. Let me give a couple other points that we have to think about. One is, and Troy and I like to spend time with the founders. In a best case scenario, quick advice. I actually tweeted this, I think, yesterday. My first rule of hacking serendipity is get yourself out there. Just get out and do stuff. Troy said I was judging his Kellogg pitch competition this last week. I judge the some of the NVC stuff at Booth. I mentor at Pritzker and all these. The more you can get out, the more you can meet people from across the founder spectrum and just get to know more people. A, more people know what you're looking for, and B, that leads to deal flow or opportunities, as we like to say. But you're going to start to get to know people. I was a judge. Actually, I wasn't even a judge. I was I spoke at the beginning of a like a pitch presentation. It wasn't really a competition. They were just sort of like pitching. I ended up investing in one of those founders. It was the founder of Microcycle, because I got to know her, and over the next couple months, I said, "Wow, she's really fantastic. I want to jump in on this." So the more you're out in the community, the more you're going to have the opportunity to get to know these people. We have to also be very cognizant in the amount of time that we're spending with founders relative to the size of the check that we're writing. So if you're going to be writing $1,000 check, you're probably not going to have any access directly to the founder, because they just don't have the time when they're raising $1 million or more round, or even a $500,000 round. There's just not enough bandwidth. So one of the ways that we try to scale this at Lofty Ventures, when we do a syndicate, which we only do a couple a year, but when we do a syndicate, you have access to, we will do a pitch just like this with the founder, and we have a Q&A afterwards. So even though you're not necessarily talking with them directly, you can be at the live pitch and you can listen to them. You can drop questions in the Q&A, see how they're responding to that. That's a way that we're trying to scale your ability to interact. So whether you're investing in a Lofty syndicate or somebody else's syndicate or whatever that is, the more that you can see and read actual body language from the founder and see, do I believe this person? Do I have questions? Like, that's all really, really important. So one of the things that I'm really good at, thankfully, and I have been my whole life, is just getting good reads of people very quickly. And so that's where that's kind of my superpower. And that's one of the things that are really important for angel investing, is how quickly can you come to the conclusions that you need to decide yes, no with a founder. And we just can't spend that much time with them, because it's not fair. They have to talk to a lot of investors, and most of the investors they talk to aren't going to write them a check as well. So we have to be cognizant of, again, in doing no harm. Don't spend 15 conversations with a founder and then decide at the 15th that you're going to pass. It's just not fair. So next question, we've got a lot of great questions here, so we'll try to get through as many as we can. I'm curious how you categorize founders as givers. Can you get more into that? I'm not sure if the person who wrote this question has read the book by Adam Grant, Give and Take. Of course, Troy has. In fact, one of the early times that we got to know each other, he goes, "Chris, have you ever read Give and Take?" Because I was describing something and it made him think about Give and Take. And I said, not only I read it, it was one of the first times where I had read something that took what I've been believing subconsciously my whole life and made it conscious and made it a lens that I use. So the book Give and Take is actually the most important book that I recommend people, regardless whether you're in business or in personal life or whatever. I don't want to get too much into what Give and Take is, because we have a lot of other great questions here, but it basically means these are people that want to give without the expectation of receiving. And this is a prime characteristic of great leaders. It is the exact opposite of what Adam Grant talks about as a taker, who would be somebody that just sucks the life force out of everything around it and doesn't ever want to replenish. So I would encourage everybody to read that book. And if whoever sent me that message, if you want to DM me more specifics around that, I'm happy to get into that. Troy, do you have anything you'd want to add to that? Okay. Let's
Nope,
go to the
great
next.
book. You should read it.
It's really important. Not sure if this was covered. Do you invest in LLC as an angel, or does the biz model have to be a C corp? This is Troy. I know this is one of his pet peeve topics. Go ahead, Troy.
Yeah, so LLCs are challenging. They're more challenging for funds because when an LLC each year has to create a K1, the K1 flows through to the investors. If you're a fund, it has to flow through to your investors. It can slow down taxes, et cetera. It's just a lot of work for maybe not so much benefit. So I much prefer to be investing in C Corps. One way around it is I have invested personally in some LLCs with a safe or a convertible note. So I'm not technically an equity holder, no K1s, with the promise that they will convert to a C Corp with the next equity round. So it'll turn into a C Corp. Life is easier with C Corps. There are some tax reasons for doing LLCs. They generally do not apply to high growth tech businesses because in high growth tech businesses, you're generally spending more on customer acquisition. You're not trying to shelter profits, but I'm happy to have a conversation with anybody about that afterwards. It'll take a while to go into details.
Okay. In a quick note, we made this for 75 minutes. If people have to drop off early, we're going to be recording. We did start a little bit late too, but Troy, yeah, comment.
Yep. So I was gonna pull. I know you're taking questions, but I'd referred to Anthony's questions before.
I was going to let you go. Go ahead.
Anthony said that our company has 20% left in our cap space available for angel investor to help us get product built and start production. So you actually have infinite space in that. What happens generally with a financing round is you issue additional new shares. Now, that does require filing. I'm assuming you're in the state of Delaware, whatever it requires some filing. And so what happens is, let's just real quickly talk about, if you do a safe or a convertible note, there are no shares issued. There's a promise of equity in the next round. And so it's pretty easy, lightweight. You probably should have a lawyer look over it, but you don't really have to. There's some great forms online. If you're doing an equity financing where you're actually selling shares of equity in the company, there's enough filing to keep it legal with the SEC that I strongly recommend you use an attorney to do the filing, and there are attorneys who will do it fairly inexpensively. But if you're going through that filing process, you're likely to be adding shares anyway. And so you're not, even though you may have authorized 20% more shares than you have issued right now, you have the ability to authorize more at any time with appropriate signatures. I hope I answered your question, Anthony. I'm not sure. But I want to make sure you know that you're not constrained by that authorized number forever.
Yeah, and I think this could get a little bit more nuanced. So Anthony, feel free to give me an email, chris@loftyventures.com, and we can get into more detail if you have specifics around that. Another great question here. How can founders do references on angels? So if you're a founder and you're raising, I'm going to give you
absolutely.
Yeah, absolutely. I'm going to give you two.
It's a two-way street, and you should 100% know who's investing in you. I'd almost say it's more important than the other direction.
It is. So I'm going to give two quick examples or suggestions. Troy may have others. The first is founders should talk to other founders, especially founders that are a stage or two ahead of you. Talk to your peers and say, who are the great angels out there? Who have you either gotten to write a check, or who would you like to have write a check that hasn't? That's one. But more importantly, in my opinion, is who are the people to avoid? And that's really important, because getting a bad, again, first rule, do no harm. If you get bad angels on your cap table, it can be I mean, it's really hard to unwind that. It really doesn't happen easily. So ask your peers is number one. Number two, if you're a little bit on the fence or you're getting a weird vibe or something, there's two ways you can reference. You can either go to, if they've got an angel list, a LinkedIn where they've listed different companies that they've invested in, just go and reach out to a couple of the founders of those companies. If they don't have that listed public, ask them, say, what are companies that you've invested in? I'd like to reach out to one of the founders and talk to them. And that's super, like I proactively offer that to founders. Troy, anything to add on that?
No, but absolutely, founders should be doing their diligence on investors.
Completely agree. And by the way, side note, I love the fact that there are founders in here that are wanting to learn about angel. There's a lot of reasons for that, but I'm thrilled to hear founders asking questions about angel investing as well. There's a lot of reasons that I like that. I'm curious about sourcing the deals. What is a good way to find founders looking for angels? In other words, how do we build your deal flow? Troy.
Yeah. So, I mean, Chris said it earlier about you've got to get out there. Part of it's just showing up. And it is. There are ways you can do it formally. So there are things, angel groups. Not everybody loves angel groups, but there are angel groups like Hyde Park Angels. So Irish Angels. I don't know if Cornerstone Angels in Chicago is still operating.
Chicago Early with Jeff.
Chicago Early with Jeff, absolutely. And I think Vitalize.
Desi has
So
Josephine Collective.
Yep. And I'm not making any valuation here, which ones are better, which ones are worse. I'm just trying to name the ones that are top of mind. And the concept is Lofty Angels. Yes. The concept is that you have a bunch of people who want to make angel investments, and to make it easier for them and easier for the founders, they do some things as a group. So for example, they will maybe host a dinner where 3 or 4 founders will pitch. They'll pitch to a group of, could be 20, 50, 100 angel investors. We'll all get to see the pitch, ask some questions. When the founders leave, they can individually decide, I think I may want to put some money in that. I may not, I may want to. It makes it easier for the founder because they can pitch 50, 100 people at a time. It makes it easier for the investor because they have someone doing deal flow. Now, sometimes these groups get so sophisticated that they have people who are filtering the deal flow, and I've heard founders say, oh, I don't like those groups because I can't seem to get in the front door, right? It's hard to get access sometimes, but that's the concept. That's one. 2, go to all of the demo day stuff. So Techstars Chicago's demo day is this coming week. I think it's on Thursday, if I'm not mistaken, Thursday. Tickets are free. You just have to sign up. Go to 1871. It's at 5 o'clock Thursday night. It'll be awesome. You may not love the 12 companies that are pitching, but you're in the right circles, right? You start talking and networking to people afterwards, and maybe you see Chris, and Chris tells you about some deal that he's looking at that isn't one of those 12. Like, you have to be in, you want to get in the room where the activity is happening. And most of these rooms are wide open if you know they exist. And so part of our mission here is to try to inform people and make this open access that everybody knows it exists. So there's Techstars. And by the way, there's way more than Techstars. So at 1871, they have demo days for the Pyros classes. The women fintech class is amazing this year. I met with them a few weeks ago. I could not believe, they're really not angel. They're further along than that, but there are some awesome opportunities to go to demo days and things of that nature. Chris mentioned, so Venture Cat at Northwestern, its business plan competition was just this last Wednesday. That would have been an awesome one to go to. New Venture Challenge, which is Booth's version. I think their finals are coming up. I don't think they finished them. They're right around this time, but there's a ton for you to get involved. Just go show up, start listening to lots of pitches, talking to lots of people. You'll get there.
And actually, the one point I want to leave you with on that question, really, really critical, is you have to look at a lot of deals before you make your first investment. Don't look at your first deal and go, wow, that's the one I want to put. You're going to look at a lot of deals because you'll start to get perspective. I like the analogy of when you're buying a home. We looked at 50 homes before we finally purchased the home that we wanted. So you need to look at a lot of different companies and a lot of different founders. You might come back to one of those and say, oh, I really do like the first one I saw, but don't write the check on the first company you saw. Come back to it. You might have missed the opportunity, but I think it's better to miss that opportunity. There will always be more opportunities than invest before you're really ready for it. So just going, even if you see 12 companies and you don't want to invest in any of them, that was incredibly valuable. Every deal you look at is helpful. So it's a really, really important takeaway point on deal flow. We a little bit touched this, but I'll see if Troy has any other suggestions. When you talked about female angel investors, what are the supports out there for female angel investors who are new to the space? One that I'll reiterate is definitely Josephine Collective. Desiree Vargas Wrigley is the organizer of that. it is meant to support female founders and female investors.
Neil told me they were going to do something
Hey,
crazy.
Brad, your mic is on. Thank you.
So she'd be a great resource. Send me an email if you have questions on that. I can connect you with her. I'm also, by the way, this is a quick note. I will be sharing with everybody that signed up for this. I've got a 2-pager PDF that has more tips. And actually, Josephine Collective is one of the angel groups that I have listed on there. So that's one resource. Troy, do you have any other resources for women that want to get involved in angel?
Yeah, there are a couple. So there's a national organization called Pipeline Angels, and they are focused on, and it's just pipelineangels.com. I'll put a link in the chat. They're focused, I got to put it to everybody. They're focused on helping more women become angel investors. In New York City, I believe Golden Angels is still very active, which is all female angel investors, and is a great organization as well. You know, my belief is that I don't think women who are angel investors should make decisions any differently than men or anybody else. I think all of the information and data we have out there should be shared equally and equally accessible. I do think it is important to have organizations like this where it's sort of a comfortable space where people can ask questions and see people like them. I think that as important as having women, and by the way, we're using gender as one dimension of diversity. I think there are many dimensions of diversity, and I don't want anybody to think we're being exclusive of others. This was just the one we happen to talk about. But having people who look like you investing, having people who look like you that you can see and say, ooh, she was wildly successful, I can be wildly successful. I think that is absolutely as important as the checks that are written. And so I think the more diversity we get across all dimensions in the investors will lead to more diversity in the entrepreneurs. And I believe that more diversity around the table is going to lead to better outcomes overall. So there are a number of groups focused on the women angel investors specifically. And you know, and then in Chicago, there are a bunch of groups that are really focusing on trying to help some of the other underserved populations also.
Okay, so another question we have, what is Lofty Angels? How much does it cost and how do I sign up? Lofty Angels is, it's a free community. We don't charge anything. The idea, and appreciate Troy and other friends like Amanda and Ryota is the founder of one of the companies that exited, is now our entrepreneur in residence, have all joined us, and we have many others that join as guests, and we do these things called Lofty Lunch and Learns, and they're via Zoom, very similar to like this. It's just about sharing, open sourcing the knowledge that we've gained as investors and as founders that turned into investors, or founders' perspective on angel investing and all of that. So Lofty Angels is a lot of educational. We have community events where we all get together in person. We do virtual events for people that are outside of Chicago. It certainly is a Chicago-centric angel community, but anybody's welcome to join across the country. It is free, as I said, and sign up. Let me grab a link. Here is a link. Oh,
go ahead. I apologize. It's not Golden Angels is someone else in Chicago. It's Golden Seeds, and I put a link to Golden Seeds that is helping women entrepreneurs.
Yeah, and that's a great organization. If you want to sign up for Lofty Angel, it doesn't cost anything. I put in the text chat. And also, if you're watching the video, just go to loftyventures.com. I have to change the terminology, but right now it says syndicate. And then you go in there and there's a form, and that'll just basically get you on our list, and we'll send you information when we do things. I think you might find this interesting, Troy. What should justify a high cap valuation? Compared to software, many hardware companies require more funding in the pre-seed or seed round. So how high is too high for a val cap? We can spend
all right, I'm happy to. Chris, I think you posted the Lofty Ventures link just to me. Post it again to everyone. So valuation cap is a very difficult thing to put parameters around, because here's what you have to understand is that we're doing backwards math. So we're trying to figure out is if the company sells for a price we think it can sell for, and we bought it at a price we think is fair, did we get the kind of return to justify the risk? So the valuation cap dictates the delta between it, assuming it'll sell at the same price, whether it has a valuation cap of 5 million or 10 million, it's still going to sell for the same price. And so at 10 million, you'd have half the return that you'd have at 5 million on your dollars. And what you as the investor have to decide is, if this company does what I think it's going to do, is that delta between the price per share that I pay and the price per share that I sell at, is that delta big enough to warrant the risk that I'm taking? And there are some, sort of, there are some rubrics people have used in the past to try to say, oh, if it's at one point I remember hearing, if it's a 1 million ARR company, it should be worth 10 million in valuation cap. That was great until it wasn't. For a while, valuation caps were higher than that because the market was going crazy. Now I would argue that most of them I'm seeing are lower than that. But it really, in the end, comes down to what price you're paying today, what you think the exit will look like if things go well, and is that delta big enough to warrant the risk that you're taking? And so it's all backwards calculation from where you think the company can potentially exit. I wish there was more science to it.
Yeah, it's and it's a lot of this is also based on what the market conditions are like, and is it frothy? Is it, we're in a little bit more of a the pendulum swings between investor friendly and founder friendly terms, and we're certainly more back into the investor friendly period now because of the broader market.
Which brings something up, which I want to make sure I'm clear about. While it is difficult to raise money in this environment for founders, this is a great time to be investing. Because when it's difficult for founders to raise money, that implicitly means they're raising money at valuations that are lower than they would like. And I think there are some amazing investments that are going to have been made in the last 12 months, probably the next 12 or 24 months, that 10 years from now, we're going to look back at and say, oh my God, I wish I invested more in it during 2023, right? People who invested in 2021 when the market was screaming hot at super high valuation, some of them have had to mark down their investments or have potentially sold at a loss, et cetera, because the valuations were just too high. Again, that ratio of risk. But I think this is a great time to start angel investing. Do it responsibly.
Yep.
Take how much you can invest over 3 to 4 years, divide by the number of investments, hopefully 12 or greater, make some small investments, build your portfolio over time. But I think this is a great time to start investing.
And on top of not just the valuations or caps are more reasonable than they've been over the past couple of years, but it's also harder to raise capital, but that leads to a lot of founders shake out. So the ones that are able to raise and that are able to continue and that have the grit and intestinal fortitude, that's an automatic filter for, it's a hedge. There's a better chance that they're going to succeed because they're going through one of the hardest periods to not just raise capital but build a business. So there's a lot of reasons why this is a great time to invest in good founders. We got one more question we'll take. If there's other questions that we didn't get to, there were a lot of great questions. Feel free to email them to me. Again, my email is chris@loftyventures.com. We will try to get back to you with answers. If you join our community, you'll be able to ask these questions at later events we have, in person, virtual, et cetera. But I think it's a good question to end on anyway. What are other good resources for learning more about angel investing? So first of all, I said I'm going to be sharing that 2-pager. We referenced a number of angel communities that you can join, including Lofty Angels, which we've talked plenty about. I'm going to give one book, and I know that Troy's going to give a book too, and I actually have these in that 2-pager, so these will be referenced. But one book that I think is really good is by Jason Calacanis. It's just called Angel. I agreed with everything in the book, and I told Jason this, except for one thing. He said, if you want to be a good angel investor, you have to move to Silicon Valley. And I approached him about this, and he said, yeah, okay, I should probably edit it. I don't agree with that anymore. But I obviously vehemently disagree, because my thesis is literally investing in Chicago founders. And I think I've already proven that that part of the book wrong. But I think it's a good book. I actually can put it in the text chat, and it's again referenced in my 2-pager. Troy, I know you've got a book that you want to reference. If there's any other resources,
I'm not sure what book you're thinking of.
Venture Deals.
Venture Deals is a great book if you want to understand how a equity transaction works. It is very boring if you just to sit down and read. It's written by Brad Feld and Jason Mendelson from Foundry Group. But if you are actually doing a deal, you will find it page turning. Oh my God, what do I have to do here? What's the term sheet? And you will, learn things like the things that are that matter in a term sheet are economics and control, and it'll give you frameworks to think about. So Venture Deals is an amazing book written by Brad Feld, Jason Mendelson. And if you're actually doing deals and negotiating deals, it's necessary. If you're just following and you're, I'm going to throw my money in at I trust the lead investor, it might be a little overkill, but if you want to understand the mechanics of what you're doing, Venture Deals is by far the best book there is.
Awesome. Troy, any parting thoughts as we wrap up our discussion?
No, hopefully out of this, we will get more discussions and we will end up having more angel investors in Chicago supporting more early stage startups. I feel like this is a flywheel that as we get it going, it gets going faster and faster. And when I reflect back on when I started Sure Payroll over 20 years ago, there was none of this. Zero. There were no angel investing groups. I didn't know any angel investors. It is amazing to me how much the community has grown and expanded, and hopefully it will continue to do so. And those successful entrepreneurs are starting to invest, and that's going to give them more equity to invest and start their next company. And we're going to get the flywheel going faster and faster and faster. And thank you all for taking time out of your day to participate.
Yeah, I'm going to give my last parting thought around part of my why, because I think one of the most important things and I remember this very distinctly from that boot camp that I did with Troy. Why are you doing this? If you're just trying to make money, there's other ways you can do that a lot easier. The big part of my why is I love working with founders, and I feel honored and privileged that every day I get to spend the kind of time that I do with them. I do this full time though, so that's a little bit different. Most people aren't going to jump into angel and do that full time. But a big part of the why over and above just because I like to work with these founders is actually a social impact. And what I mean by the social impact is not that I've invested in 75% of the companies are run by underrepresented founders. That's just because we have a lot of great companies in Chicago that happen to be run by underrepresented founders. That's coincidental. The social impact I'm trying to create is through geofocusing my dollars in Chicago. As an angel, if I'm spreading the small amount of capital that I have across the entire country, it's not going to make any real difference from an economic impact in any of those markets. But if I focus it in one place, it can have real outsized impact. And we've already seen this. One of the companies that I invested in, QB, already exited for $100 million. And those founders are now all angels investing in the next generation of Chicago founders, which are hopefully building jobs and tax base and more wealth creation for those founders and their families that then can create more jobs and more, and it just continuously grows, as Troy was saying, in the flywheel. So think more about the why than just, I want to make money, or maybe I want to support underrepresented founders. Those are all great things. And I'm not saying not to do that, but you can it's a playground. Like, this is your capital. What do you want to do with it? How do you envision the world that you want to live in? And this is a great vehicle to do that. So hopefully that inspires people to think a little bit more. It doesn't have to be a geo focus on Chicago or what have you, but think more creatively about the why behind why you're doing this, because that really should be a huge driving force in becoming an angel. Anyway, with that, thank you so much, Troy. I can't thank you enough. My career is deeply tied to the knowledge that you've imparted upon me, and hopefully others in whether you're live here or watching the recording, hopefully you've gained a little bit of that insight from Troy as well. Thanks, everyone.
Thank you, Chris, for doing all this for the community. I love what you're doing about building community, and I think Chicago will benefit immensely. So thank you.
Thanks so much.
All right.